Good morning, everyone. It's Sean Sandilands from Pulse Markets here with John Forwood from the Lowell Funds Management. Just touching base. Last time we were at the RIU where we discussed what was happening and we'd just like an update. John, how are you today?
Sean, I'm very well, and great to be talking with you again.
Well, thanks. Listen, I'll get straight to it. It's right before the market open, beginning of a new year, so I'm sure we're going to be busy today. But I've just got a couple of questions that our investors and yours would like to know what's happening, just an overview. Can you just give us an update of what you think is happening in the junior resource space at the moment, please?
Look, there's always plenty happening. At the moment, there's a lot going on. I think what we've got is we've got plenty of projects in the junior space. We've got plenty of money. There's been a real rush of IPOs. I can think of four junior resource companies that are listing just this week. One that's not so junior, 29 Metals, has raised over $500 million and is due to list this week. So there's plenty of projects and money. What there isn't is perhaps plenty of people. The talent pool gets stretched a bit thin in these sort of times. And we're seeing that, with drill rigs, geologists are in short supply, and assay labs are in demand, and assay times are blowing out a bit. I think, big news, probably, from our point of view, one of the biggest maiden resource announcements came out last week, which is De Grey at their new Hemi discovery, which announced a massive gold deposit of 6.8 million ounces initial resource. And they're growing that at nearly 500,000 ounces a month with, I think it's 12 rigs going hammer and tongs up there in the Pilbara. So that's possibly one of the biggest pieces of news. I think, sort of in the markets, perhaps a big piece of news is the Chinese government trying to keep a bit of a lid on commodity prices. We've seen China selling some of their strategic reserve stockpiles in various metals like iron ore and copper. But in our view, that's a bit like King Canute trying to hold back the tide. There's the fundamentals of demand, being driven primarily by China, are very hard to stop.
Okay, that's really interesting. With commodities where you've just spoken about, what's the Well focusing on at the moment? What commodities are you really paying special attention to at this point in time?
Look, for some time, we really like quality gold projects with good exploration upside, and particularly ones which have obvious potential for being taken over, either because they're, just fantastic projects in their own right, or because they're good projects in areas where there are what you call hungry mills, i.e. Other gold mines which might be running short of ore and need to find more ore quickly. And with the good, strong gold price, which has been prevalent for the last few years, the ability to truck ore long distances, if it's reasonable grade, just gets greater and greater. So the potential for takeovers by existing producers of newly found resources is really good. So we like good quality gold projects, particularly in WA and in West Africa. Copper, remains subject to really good fundamental demand drivers, of electrification and general sort of stimulus, and in particular electric vehicle growth. And copper also has its supply challenges, such as strikes in South America.
Okay, thank you. With your focus on gold and copper, from what you've just said, have you been doing sector rotation within the portfolio, selling out other sectors to get into more gold and copper stocks, or have you still got a neutral balance across the commodity sector in general?
Look, I think we're very happy with our gold allocation. It's around 50% and has been there for some time. What we're working to increase is our exposure to lithium in terms of electric vehicle batteries. and to oil and gas production. We're seeing energy prices rising across the board, from Brent oil prices through to Australian East Coast gas prices. So we think that those people with energy reserves in the ground or current production are going to do pretty well.
Okay, great, thanks. With that bearing in mind, increase in prices and obviously all this cheap money that's available globally, what's your view on inflation and how will that affect the junior resource markets?
Look, my view is that inflation is all around us. We're seeing it from used cars to timber prices, real estate, housing costs, shipping costs. It's everywhere. We've seen a lot of stimulus from governments and central banks. COVID doesn't look like it's going to go away easily, so I think that stimulus will have to continue. And we've seen central banks be super reluctant to even talk about raising rates. So I think we've got inflation, we've got low rates. So I think we're going to continue to see negative real interest rates, and that is very good for what you might call the more speculative end of the market, which is where the junior resource sector is. You see the Nasdaq, for instance, really very strong, and it's also good for hard commodities like gold. Negative real interest rates and gold prices are, at the moment at least, quite strongly negatively correlated.
I noticed, thank you for that, sorry. I noticed over the last 12 months, and I'm looking forward to an update very shortly of how you've gone last financial year. I've done my research and I know your fund, 100 plus returns. It's fantastic. A lot of my investors that were put into the well have done extremely well. The question I think I'm asking, and my investors will ask me, is what do you see? The last 12 months was very great or very good because of COVID, the rebound the market had. Do you think you could perform the same in the next 12 months? Do you think there's the same opportunities that you had last financial year that could present themselves this year?
Sure, and look, the fund did. Thank you. The fund had a fantastic 12 months, particularly starting in March last year from the COVID lows. But it's grown over 100%. But it's still a small fund. We don't mind being small. It means we can get in and get out of these small companies relatively easily, and we can still move the needle if they have great success. So we think we've still got a huge amount of growth to come. Just in big picture, the 2010s, the decade, was largely a decade of low prices and underinvestment in resource projects, and we're seeing 2020s, in our view, as a decade of catch up. So what we need to see is high commodity prices to stimulate investment in new production in the sector, and those high commodity prices will always be reflected in the junior resources sector. I think the other thing that perhaps flows on from that is the fact that if you've got high prices, it means that the bar is lower in terms of exploration, i.e. Something that may not have looked economic 5 years ago now looks like a very attractive project. So in terms of a new discovery, I think we're seeing more discoveries because there's more money going into the sector, of course, but also because the hurdle for an economic discovery is somewhat lower, and that's the sector that we play in. And we think that there'll be, given the good funding and the high commodity prices, we think there'll be a lot more discoveries to come, and that's where you make your 10 baggers.
Tell you what, that's really good to hear. I think our investors will be really happy to hear that. Listen, John, market's opening very soon. I've got to go and do some trades at the beginning of the year. We've got to reposition portfolios, as I'm sure you'll have to. But I really want to say thank you for your insight this morning. It's very refreshing. We are big supporters of you. We do really think you're going to do good things again this year. And I just want to say thank you for your time.
Sean, look, thanks very much for your support, and thanks for having me on again to have a chat to you, and look forward to doing it again in the future.